historical context, very little has been usual. One market commentator aptly summed this up. He said, of the conditions of the last few years, the word unprecedented has become unprecedented. Let me, in 30 seconds or less, try to sum up just how unusual the past 3 years have been. In the second quarter of 2020, US GDP fell 28%. This is 2.8 times worse than any other quarterly decline since World War II. The resulting fiscal stimulus drove a $9 trillion, 40% surge in US federal debt. Deficits spiked to 15% of GDP, far dwarfing the 10% height of 2009. The Federal Reserve subsequently monetized the stimulus. They increased the money supply by 40%. The balance sheet of the central bank rose by 110%. Bond yields hit all-time lows. And then 2021, in response to all of the stimulus, GDP rose the most since 1984. Stocks surged. This included a mania in meme stocks, losing money or money-losing IPOs, and cryptocurrencies, which, in cattleman parlance, turned out to be all hat and no cattle. US housing prices skyrocketed 45%. A spending bonanza ensued with the consumer. Durable consumption rose 45%. Inflation soared to 40-year highs. The number 40 could be so well referenced in the last few years, it starts to sound biblical. I can assure you it's not. Cumulatively, the events of the last few years have fundamentally altered the trajectory of asset prices, interest rates, and inflation. The long-term implications are many. The handbook of the last decade is no longer a guide. But let's start first with the near term and the current environment. Today, ongoing distortions continue within the economy and continue to show very unusual indications and a violent, compressed market cycle. Unsurprisingly, most economists and stock market pundits are unable to agree whether it's dusk or dawn for the economic cycle, whether it's a bull or bear market. If we look to the US, the latest GDP report was very strong. Unemployment is low, inflation is falling. Economists call it a Goldilocks economy. What's not to like? Well, as skeptics and part-time food critics, we'd point to the flies in the proverbial porridge. A strong economy is at odds with the current trends in bank credit growth, which is an outright contraction. For context, if we go back to the 1970s, bank credit has only contracted once, and that was in the wake of the financial crisis. If credit's the lifeblood of the economy, and it's not flowing well, how healthy can the host be? Consumer spending is supporting the GDP growth currently, but it's also being driven by a negative spending rate as savings decline, as the remaining government stimulus dollars stuffed onto consumer balance sheets are being exhausted. After the popularization of the YOLO approach to investing during the 2021 bubble and implosion of meme stocks, which YOLO for the non-millennials in the crowd is you only live once, the consumer now appears to be YOLOing away the rest of their excess savings to satisfy purchases today. Meanwhile, credit card loans, consumer loans, and auto loans are seeing levels of delinquency which are the highest since around 2010. New mortgage applications, they're at 30-year lows, as 30-year mortgage rates in the US have approached 8%. Small business loans, which were less than 4% just a few years ago, have more than doubled to 10%. None of this suggests a lot of strength. Let's add to the contradiction that we see today. This is all occurring alongside unabated fiscal profligacy from the US government. The US deficit continues to run at 5% of GDP. This is a level of spending that's historically reserved to jumpstart the economy in recession, not when unemployment remains near historical lows. In some ways, it feels like running a marathon as a warm-up for the big race. It doesn't make much sense. Bond investors are clearly frustrated with all this spending, and you can see this in the wild daily swings of the 10-year bond yield that have become now quite commonplace. We genuinely wonder who will absorb all the coming treasury issues in the next future years. Foreigners seem less willing than they have in the past to. The US 10-year bond yield is the benchmark rate. It determines the price of most other assets around the world. Undue volatility in the 10-year bond courts the risk of unexpected outcomes and something breaking. Let's move back above the border. The Canadian economy hasn't really grown since May, and there's a reasonable chance we're in a soft recession. When we look at the trifecta of consumer debt levels, the pull forward of spending, and the forming wave of mortgage refinancing at much higher rates, a debt hangover is suggested and a lower path of growth forward. Record immigration offers a demographic tailwind, but risks exacerbating underlying inflationary pressures and sky-high housing prices. A so-called soft landing may be possible, but to borrow a colleague's analogy, it may be like trying to change a tire while doing 100 down the highway. Possible, not probable. Of course, in offering expectations for the economy in the short term, we are always reminded of life on the farm, where the fate of the rooster that only caws at midnight is the chopping block. We'll try to keep our caws from being too brash or too loud, and we'll point out that in the past we were actually right, that inflation and interest rates were too low. However, we were wrong for a long period of time before we were right. Now, if we step back and we consider beyond the veil of the very near term, the broader events and the policy responses of the last few years have set forces in motion which appear likely to redefine the coming decade. The 2010s were defined by extraordinarily low interest rates, low inflation, lack of demand, rising corporate profit margins, sometimes at the expense of labor, and rising asset prices and valuations. The big themes which will significantly influence the arc of the next 5 to 10 years are likely simplified to 2 R's and an O. The first, regime shift. There has been a secular change in interest rates, inflation, and stability in the world. As Dorothy said, we're not in Kansas anymore. The implications are significant. The second R, mean reversion. This is an often quoted, less understood phenomenon where economic forces tend to fluctuate back to average levels over the long term. Not unlike the chains of habit, too light to be felt until they're too heavy to be broken. The forces of mean reversion are often too subtle to be noticed until they become too powerful to be ignored. Many of the forces that drove markets in the prior decade are now in reverse. Investors would do well to consider past regimes where inflation and interest rates were high, longer-term averages than the past decade for reference, and the potential for the sum of little forces to culminate in bigger themes. The O is for opportunity. The opportunity set is shifting today, even if it doesn't look like it in 2023, where 7 stocks are driving all the return in the S&P 500. Investors looking to the recent past for sources of future success may find it's a lot like trying to drive down the interstate by looking through the rearview mirror. Interest rates. After falling for 40 years in a more or less linear range, the downward trend in interest rates has been forcefully broken. While rates would still likely decline in a recession temporarily, higher structural inflation and higher government debt and deficits mean the era of extremely low interest rates may be a relic of the past. I think the implications remain underappreciated today. Many areas of the stock market have yet to reflect the impact of higher rates within valuations. Housing prices have rarely been so unaffordable, as I'm sure everyone knows. In 2018, for reference, the median house in the US cost $253,000, and at a 4% 30-year rate with 10% down, the monthly payment was $1,086. That same house today costs $399,000, and the comparable mortgage payment is $2,547, a 134% increase. Prices will have to fall, or incomes will have to rise to drive a resurgence in transactions. Strong economies require strong housing markets. The cost of home ownership presents a headwind. Consumers will and are learning to adjust. It will take time. Businesses will have to learn to live with lower consumption. Profit margins can be pressured as debt is refinanced at higher rates, and stock buybacks, which have been a meaningful driver of earnings per share growth in the past, may wane as capital is diverted to debt reduction. It's not all negative, of course. In past years, a lot of well-financed businesses found that there was a lot of competition as alternative capital pools like private equity had crowded out investment and good acquisition targets in an era of low interest rates. Suddenly, these alternative capital pools may find the hurdle rate to compete is much stiffer. Inflation. Interest rates and inflation are bound at the hip over the long term. There's a very strong record of inflation following the money supply in an economy, but with a lag. With money supply in a decline today, it wouldn't be surprising to see inflation continue to fall in the near term. But sticker shock is still likely to have lasting effects on consumer behavior. I think everyone can attest to that $6 bag of potato chips that used to cost $4 and having double the gilt at the bottom of the bag. Belts have been and will continue to tighten. It's not a bad thing, but it does involve some discomfort. So what will happen in the next recession, the next crisis? Will fiscal largesse and money printing come quickly back to the rescue and risk another surge in inflation? We remain skeptical that elected officials will be able to quickly put the stimulus genie back in the lamp once it's out. The experience of inflation in the 1970s was only possible with the oil crisis of the Yom Kippur War and the Iranian Revolution. The geopolitical landscape is different today, but the parallels to the tension in the Middle East shouldn't go unnoticed. Neither should the fact that Western energy companies have chosen to give capital back to shareholders rather than to invest in future production. This runs the risk of supply constraints in the future, the potential for higher oil prices, and with it, more inflation. The broader poles of supply and demand have shifted in the global economy in recent years. The last decade could be characterized by a persistent lack of demand to drive economic growth in the wake of the financial crisis, as companies and individuals repaired their balance sheets. Today, as the economist Mohamed Al-Arian has suggested, the challenge for coming years may be a lack of supply. As manufacturers in Europe have acutely witnessed in the last year, regional conflicts create shortages and inflation in many facets of input prices and commodities. The pandemic also exposed the risk and weakness of long supply chains, while rising geopolitical tensions have exposed the risks of globalization. This is a force that has been so beneficial for multinational corporations for many years. The rise of nearshoring and onshoring are inherently inflationary, and they'll reverse some of these deflationary benefits of past decades. Domestically, an increase in associated capital expenditure to support this should create opportunities, though, for the providers of picks and shovels. The US's $550 billion infrastructure spending bill will as well. Labor. The shock to the cost of living has driven employees to hunger for wage increases. Inflation-adjusted wages have languished for decades. In 2023, however, labor strikes have risen to two-decade highs. Salary concessions from businesses have been significant. Wage growth is the reciprocal of corporate profit margin. Expect wage growth to be passed on to customers through higher prices. In the 1970s, similar dynamics fueled an inflationary wage price spiral. Now, of course, inflation is the friend of the debtor. It's a soft, unseen salve that reduces the value of liabilities. It silently robs lenders and lowers the burden of debtors. There's a long history of governments alleviating their burdens through inflation. For many years, the Federal Reserve has stuck to a 2% inflation target. It will be telling in coming years if the Fed decides to step away from this target. Cumulatively, all of these factors suggest persistent inflation may exist, and it may be beyond 3%. We'd be remiss if we didn't talk about geopolitics. This has created a new source of uncertainty for investors. The world's moved beyond a period where global stability was underwritten by the sole dominance of the US. Greater regional instability provides a welcome distraction for bad actors to entertain unchallenged conflicts in other theaters. In a world of regional powers and allegiances, the world is a much more unstable place than it has been in the past. Historically, isolated conflicts tend to be flashes in the pan for stock market indices. However, the historical data set also suggested that pandemics had limited impact on stock markets, and we know how that went. All else equal, this reinforces our process of owning stable businesses that operate in stable jurisdictions. So where then is the opportunity? First, we would say, be careful looking to the winners of the last decade. As the Queen of Hearts in Alice of Wonderland said, it's a poor sort of memory that only works backwards. Performance and the factors which drive it shifts around in the stock market from decade to decade. The starting point for valuations, revenue growth potential, and profit margin matter. Investors always have to be open to where our opportunities are relative to where they were. And in past decades, where inflation was persistent and interest rates were higher, hard assets, businesses with inflation pass-through, businesses with pricing power benefited disproportionately. An attractive valuation can go a long way to supporting reasonable outcomes in such an environment as well. US stocks have just had the best decade in history relative to the rest of major developed markets in the world. They're also very expensive relative to the rest of the world. Canada looks particularly cheap. Attractive dividend yields can be had in stable franchises and in an economy which benefits from inflationary pressures that, given the exposure to hard assets and commodities, can be beneficial. These factors lower the barrier to achieving satisfactory returns in future years. You may even be aware of an investment manager with a long, successful track record of buying quality businesses at attractive prices in Canada. Opportunity. We can see it today also within the markets. There's a record dispersion between expensive areas of the market and more cheap areas of the market. This offers fertile ground for discerning investors. The valuations of our strategies today suggest we are quite reasonably positioned to benefit from this opportunity. In contrast, owners of S&P 500 ETFs may find themselves scratching their heads in a few years' time. Irrespective of the path of the economy, we think there's deals to be had today. In our small cap strategy in Canada, we're a long-term owner of the happily boring packaging manufacturer Winpac. Conservatively managed, highly profitable, this 5-decade-old business offers an 8% earnings yield today. This is a rare level over the last 2 decades. In our global strategy, we recently purchased a business that is an Austrian manufacturer which provides machinery for pulp and paper mills, hydroelectric plants, and separation facilities such as water treatment plants. The balance sheet's in a net cash position. The longtime chairman owns $1.5 billion in stock. If he can sleep well at night with this investment, so can we. Andritz's 11% earnings yield looks like a deal to us today. So we've prognosticated on economics a lot tonight, but there's a reason that we spend our days focused on company analysis, paying the right price for good businesses, and long-term ownership. I'd like to illustrate why with an example. This is an excerpt from an annual report of BASF. BASF is the largest chemical company in the world. In this, it's a letter to the shareholder from the CEO explaining his outlook for the coming year. And I read, "The geopolitical events of the last year have changed the world politically, socially, and economically. Their effects are far from over. It was an exceptionally difficult year for the global economy, and income from operations declined 33%. I anticipate it'll be another difficult year for the industry as a whole. In addition to economic challenges, we're faced with adverse political conditions. The European Union's strong tendency towards overregulation in its current policies is particularly counterproductive. Both of these factors create worrying uncertainty with regard to capital expenditure in the industry. It threatens the industry's capacity for innovation. It endangers jobs. This is a long list of things to worry about. Here's the kicker. This excerpt was published over 20 years ago on March 18, 2003. This was in the midst of a market crash, and it was within a week of the absolute low of the stock's price. BASF is not a great company, but sentiment was low, it was very cheap, and its earnings were, while cyclical, were linked to the economic growth of Europe and the world, and they were set to improve. Over the following 5 years, the stock rose 137%, or 23% annually if you factored in the dividend. If you'd worried too much about the CEO's concerns about the economy or the outlook, you would have missed a great opportunity. The risk of recession, inflation, and geopolitical struggle were concerns 20 years ago for BASF, and they're concerns today, but not enough to keep us up at night. Having balance in your portfolio helps. QV's clients' funds are well balanced today between stocks and bonds. I believe both constitute good value. The near term is always uncertain, but if adversity beats down equities, bonds will provide ballast, and they will provide a stable source of funding to buy stocks at more attractive prices relative to their invested capital. With the benefit of time, this helps ensure the certainty of the long term. Thank you again for joining us tonight and for entrusting QV to grow and to protect your wealth.